Hi, welcome to this installment of the Master Series Roundtable discussion with Jeremy Lemire from Star Capital Management Group, Dr. Lee Newton from drleenewton.com, and myself, Michael Parks from Spire Investment Properties. Today, we are talking about cap rates, talking about cap rates in inflationary times and cap rates and interest rates and how those link or don't link. More to come. So let's start off with the basics. What are cap rates? Dr. Lee, can you please tell us a little bit about what cap rates are?
In real estate investing, cap rate or capitalization rate, if we're, billable by syllable, if you will, is simply a ratio. It's a mathematical ratio that compares the net operating income of a real estate investment or property to the price of a property. Okay. So in order to understand that, we better define what net operating income is. It's if you have a multifamily or a commercial property, it's all your income minus all your expenses. Financing is not even part of the picture. Finance is irrespective. Doesn't matter if you finance 100%, if you're lucky enough to do that, or if you finance 0% and you didn't get a loan on the property. So you take your net operating income, let's say, because Lee math is easy math, $100,000. $100,000 and the value of the property is $1,000,000. So that's 10%. So what that in essence is saying is that if you paid $1,000,000 for that property and you paid cash and it produced $100,000 a year, your rate of return would be 10%. Now, real estate investors try to do better than that because we leverage our funds. We don't put down 100% cash. But if you were to do that, then you could look at it like, okay, I am capitalized or recapitalized 10% a year based on what I put out to buy the property. So there's a possibility it can get confusing when the term is thrown around like, okay, I constructed a building and I rented it out and I did that all at a 10 cap. Okay. Or, the market's up, the market's down, cap rates are compressed. What does that all mean? In the inflationary era that we're in and probably just got toward the tail end of, prices went up and up and up. And if prices go up and the income stays the same, well, the cap rate or that, if you're a mathematical stalwart, the quotient goes down because if I'm making that same $100,000 net operating income, but I had to pay $1,500,000 for the property, well, I'm not making 10% anymore. I'm making 6.7%. So if cap rates are compressed, prices are going up for that same amount of income. And if cap rates are going up, that means that, well, your property may not be worth what it was when you bought it, but you may or may not care because passive income may be the top item on your priority list. So again, cap rate simply a comparison between the net operating income of a property and the purchase or acquisition price or value of a property. But it's very, very easy to conflate the terms if you have an existing property and then the market goes up, the market goes down. It's nice to know what you're talking about relative to the other terms.
Yeah, that's a great explanation. There's certainly a lot of math there to follow, even if Dr. Lee's math is simple. But one of the things that confused me when I first got into this game and understanding cap rates is the cap rate is set by the market. The market determines what people are willing to pay for a property that makes a certain amount of net operating income. I think a lot of people look at it when they first get involved and they say, well, this building makes a 10 cap or this building makes a 12 cap. The cap rate is set by the market. So if your building makes more money, whatever the market cap rate is will determine the value of the property. Uh, so that's the way I think about it simplistically is what is the market cap rate? How much money does it make? That sets the value of the property. So with that, let's talk about cap rates in this inflationary environment. And I'll turn it over here to Jeremy. Jeremy, what are your thoughts on an inflationary environment and that's impact on cap rates?
I think Lee's discussion relative to the changing cap rates is an important piece of that understanding. As folks are looking for return on investment, they may adjust their return that they're accepting. So, if they have funds available, and there's this kind of iterative process of walking the cap rate down, and if they have more and more funds available, they may pay slightly more for a property to put those funds to work. Otherwise, they get zero return, or they only have an alternative of, whatever return they can get in a money market or something like that. So, right, there's a point at maybe 2% or 3% or whatever that may be. Today, maybe 5%, 4% ish on different types of bonds. But that's one of the risk-free opportunities that they have. But they're going to choose something else with higher risk because they want higher return potentially. And you may see that cap rate much higher than the actual interest rate. That will change tied to the interest rate, because as we mentioned, the situation with paying for the debt that we have on a given property comes after the net operating income is determined. So we actually, during inflationary times, we're pushing interest rates up. As we push those interest rates up, we need more buffer in that deal in order to pass net cash flow to the actual investor on the backside of the deal. There may be some appreciation that comes with that inflation. It becomes a delicate balance of the inflation piece that's happening to the property itself, but there's also a cost on that debt. If you have to either refi the property over time because it's a commercial property, or you run through your 10-year term on a fixed rate. So those things can adjust the actual inflation difference in the cap rate and force cap rates to rise in this particular case, because you need more funds to come through to the bottom line as you're paying for that higher interest rate, which the Fed is trying to use to counter the inflation situation.
Right. So what you just described is inflation driving interest rates higher, forcing cap rates to go up, right? I think what I love about, one of the things I love about multifamily is there's a lot of forces at work that determine values. So another angle on inflation is that people just expect to pay more for everything. That's the definition of inflation. You're paying more for the same things. Well, one of the most important things to everybody is housing. So when housing costs go up, when rents go up, in an inflationary environment, it's not abnormal, and it tends to get prioritized over other things that might be more of a luxury in some cases. So as a multifamily owner, even if your interest rates are working against you on the cap rate, your rents can potentially get some increases, which can offset that, creating more income, then pays for the higher interest rate. So there's competing forces. And I think that's one of the things that gives multifamily a lot of stability compared to other asset classes that don't have quite so many competing forces in play.
I think it's really interesting. There is a expectation of return that folks have for a given asset class. So we may find that the cap rate for one asset class is different than another asset class, depending on its effect or how it's affected by inflation, and whether that asset actually suffers in net operating income due to inflationary pressures. But as you mentioned, Michael, apartments are somewhat unique and recession resistant in a sense. Recently, over the last 4 or 5 years, they've identified self-storage to follow that similar trend. And it has driven the cap rates prior to the inflationary period, had driven cap rates very, very low. And now as inflation is coming into play and the interest rates are pushing hard on that debt service, it's really driving that cap rate back up again in order to have those funds available should you have to refinance any of those term debt situations for those asset classes.
That's a great point, Jeremy. And I was wondering, and maybe you and Michael could address this because I feel like I'm more of the student in this exact realm, but what would be our, generally speaking, our sensitivity toward the cost of debt exceeding the cap rate? In other words, the cap rate is okay, if we pay it all cash, well, it's this. Well, we don't pay all cash. We're real estate investors. We have leverage. So if we, as an example, maybe we have 80% leverage, we put 20% down, just a quick Lee math example, and the cap rate is 6. If you divide 6 by point 0.8, you get 7.5. So if you exclude closing costs and soft costs and cap and reserves and all that stuff, could you just say, well, if the cap rate's 6, I can tolerate 7.5% interest on my debt and still potentially, based on other due diligence and underwriting, potentially have a deal.
Yeah. Interestingly, Marcus and Millichap typically publishes a 10-year bond chart relative to kind of cap rates. And what you'll find is actually the higher the interest rate, the closer the cap rate is actually to that interest rate. What we've seen in the during the period of the last 5 years, as we went through COVID and they dropped rates significantly, the spread actually increased. While it was trending down, the actual spread did open up even wider. I think part of that is potentially the cap rate, interest, to exactly to your point, that there's a magnification that happens in that. We probably haven't experienced in the last several decades any very high inflationary periods or high enough periods to drive interest rates into that double digit category to start to see whether those numbers really cross each other. Because there is a practical point to your identification of cap rate under all cash conditions, all cash purchase conditions, right? You have a crossover point where interest rates don't make sense. I might as well pay cash for the whole thing because I'm going to pay more than what I'm really demanding for my rate of return. If 10% were okay during a very heavily inflationary period or oriented period. So there is kind of that crossover point where you're going to almost get on top of each other, where you're just trying to stay ahead of that inflationary situation.
I can see as interest rates go up that buyers are going to have a certain, reduced willingness to pay asking prices. So asking prices may go down, which makes cap rates go up, and kind of there's a little bit of give and take I can see in that whole relationship.
Yeah, I think if interest rates were to go up slow enough, we would be able to maintain, right? They were slow enough because inflation is happening. That NOI can keep happening, as Michael mentioned. Rents are increasing. You may be able to keep the price okay, or stable. Maybe the price stays stable in the right circumstances, but the cap rate is still adjusting in reality. So it really depends on how fast one moves versus the other, and whether you can move the rate of rents in this particular case, whether it's storage or it's apartment buildings or commercial space. Right, you could actually see commercial space during high inflationary periods actually get more problematic because maybe it hurts business in general, and we actually have more vacancy. So as you have more vacancy, your net operating income, you lose one of your 10 tenants just because business is pulling back. You could end up with significant impacts on that particular asset class. And yes, then we'll see that price adjust significantly because people will go over to multifamily and storage versus retail.
Yeah. I heard a number of people in the last 6 months talk about cap rates not being linked to interest rates. And to me, that is just a little bit bonkers. That may have actually appeared to be the case in some months because interest rates have moved so fast. Cap rates have not quite moved as fast. And, part of that is cap rates are a lagging indicator. It's based on transactional sales that have happened. And some of those deals were cut a year ago. A lot of those deals a year ago fell apart, but some of them made it through. And so it's a lagging indicator, not a leading indicator as to where the market's going. So I think that's part of it. The other part of it is many people will, in the multifamily investing space, will do what's called value add. And when you do value add, whether you're renovating units or however you're getting there, you're ultimately creating more NOI, more income through additional rent raises or reducing expenses, as the case may be. And so sometimes people who have a heavy value add apartment building are able to pay a higher price at a lower cap rate, and then it transacts at that lower cap rate because they have a plan that gets the income up. And that is where you get a good increase in your returns, is when you can get your income up, increase the value of the property, in addition to just collecting the cash flow from the rent. So I think we're seeing a lot of that in the market, where those heavy value add deals are the ones that are still able to transact. And that lagging indicator is showing cap rates not moving as fast as interest rates, but they've got to be linked. At some point, you're borrowing money at a certain percentage. You have to make more than that on the other end, or you wouldn't do it, right? So I think we're gonna see cap rates start to move even a little faster than they have in the past, unless we see interest rates go back the other way. But it seems like we got a little bit of time before that happens.
I agree. Great summary on that, Michael.
So if we get into another trend of reducing interest rates, so interest rates going down, uh, demand is high. Demand has stayed high. Housing is at a premium. We do have housing shortage in many sectors. Okay. Could I propose another rate to look at in comparison to the cap rate? We'll call it the new rate. And what I mean by that is there's a certain value in an existing property because it's already there. So if you want to buy it and it's for sale, all you need is the money, right? So if cap rates are that compressed again, if they get compressed down to 4, 5, even 3%, because the big $1 billion institutional investors, hey, that's better than nothing. Okay. Could you sit back and say, all right, I can replicate this net operating income. Here's what it's going to cost me to do it in that market, diminished by the time value of money, 2 to 3 years to put it together and go through the permitting and the construction. And can we call that the new rate? What would be the perils and the pitfalls of having that comparison if we get into those compressed cap rate times again?
Yeah, I think you're hitting on really there's 3 ways to value real estate. The 3 main ways. One is the cap rate, and that's the primary way for apartment buildings. The second way is exactly what you said, Lee, which is replacement value. So what would it cost to rebuild that same building today? And with inflationary environment, that's going to cost more today than it did last year or the year before. So in that valuation model, it's going to go up significantly with inflation. And then the third way would be on comparable sales, which is used even less in multifamily, but very common in single family, is what was a house just like this one sold for last month or 6 months ago.
But if the cost went up, the income may go up as well. So it might be a little bit like a dog chasing its tail. What is that balance point?
Yeah, and that's key. That's key, right? There's a slope to the line between A class and C class. And as we tilt the line, because there's overcapacity for A class, we may find that it flattens out a little bit to C class. And we have, we get that free market situation where some of the C class can afford to move up to a B class because it's not that far away, but then it consumes it. And then we have the aging factor. Over time, as this cycle happens, 5 to 10 years, what was brand new is no longer brand new. And we get into this capacity shift into different categories. In each unique market, we talk about real estate being local, and that's a reality, right? How old is any given asset group that we have and how much of it is there? And then why we step in as apartment investors and come in and take a C class asset and try to push it up to that B class level, because of the opportunity to get low cost money and utilize that cap rate to leverage it to magnify, to create profitability. Whether it's on the cap rate side, we can buy that property at a 4 cap, but in reality, when we get done investing the capital in it, it's operating at a much higher cap rate after the fact. So what Michael alluded to before about that cap rate being lower, when you purchase that value add, it actually jumps up because we created that net income, but we locked our investment component at the purchase price plus our improvement capital. at a very low cost of capital. So we're willing to do that much more quickly when we have low interest rate environment compared to, 8, 9, 10%, which is approaching just putting your own funds straight into it, dollar for dollar.
Thus underscoring the benefit of having dry powder in inflationary times and low interest rate times, because it always helps.
Yeah, especially if you can see in the future that there's a runway to that inflation. I know a large number of individuals, large and apartment complex owners, that could see the capacity situation or the constraint of availability. And during the slow times, they start acquiring the land and getting the permits ready, and they start plugging in large scale apartment complexes with the labor and materials when they're at their weakest point. And by the time things heat up and ramp up and that inflation pressure hits, they've already got an asset built at an historic value, and they get to ride that rent increase and the valuation increase of any new assets while their assets may be only 2, 3, 4, 5 years old. And they get the benefits of nearly new, while at this time we're paying substantially more than what we paid 3 years ago for the same asset.
Yeah, that's exactly right. And I'll just wrap it up with this thought, which is that, a year ago, there was a lot of development going on. There's a lot of deliveries happening. There's a lot of new starts of apartments that were in the works. And then with the rapid rise of inflation, the rise in interest rates, and the rents not keeping pace as quickly, many of those development projects have just gone on hold or gone, they just died, right? And so what does that mean? There's a lot less new apartments being delivered into many markets right now because the economics aren't there to support them. Yet there's still a lot of people looking for housing in many of those markets. So it's a matter of time before the equilibrium comes back and the numbers start to pencil again, whether that's inflation coming down, labor rates coming down, materials coming down, or interest rates coming down, or rents going up. And at some point, they'll start to pencil again. And to your point, Jeremy, those people that are ready, that have the projects lined up, that are entitled, that have the money, they're the ones who are going to be able to jump back in the market and ride it on the way back up. So I think there's a lot of opportunity ahead of us in this turbulent time. And so that's why we all continue to look for new deals every day. And when they work, they work. All right. Thank you all for joining us today on this installment of the Master Series Roundtable. We hope you enjoyed the discussions on cap rates. See you next time.